Right now, market headlines keep coming back to the same question. Are we in an AI bubble or an AI boom? Look at what's happening in the AI infrastructure trade. Oracle has given up almost half of its gains since hitting all-time highs in September. CoreWeave has also slid sharply after notching record highs in July, and the broader market barely flinched. Goldman Sachs research says AI bubble concerns are back, pointing to rising valuations, massive spending, and what it calls the growing circularity of the AI ecosystem. Even inside big tech, the message is it's complicated.
I think some parts of the AI industry are probably in a bubble, like, I don't know, like the seed rounds of, $50 billion seed rounds and things like that seems a little bit unsustainable. But on the other hand, of course, I, or more than anyone, believes that AI is the most transformative technology ever. So I think in the fullness of time, this is all going to be more than justified.
For investors, the biggest question isn't whether AI matters, it's whether the market has already priced in too much of that future. So I went to the experts to ask, are we in a bubble or a boom? Ed Yardeni is a longtime Wall Street strategist and one of the market's better-known tech bulls. Lately, he's argued investors should underweight the Magnificent Seven because AI is turning yesterday's advantages into non-stop competition. Where do you stand right now on the AI boom and bubble debate?
Well, I guess my attitude is that AI really is just an evolutionary development in what I call the digital revolution. And back in the late 1990s, when everybody was using Microsoft operating system, we had Microsoft Office, and that was really the only applications around, basically Word and Excel. And now we got millions of applications. And so along this revolution, the next thing that happened is we had cloud computing around 2011, and now we've got AI. AI to me is just a super duper application, if you will, that everybody can sort of customize to their own needs. So in that context, it's evolutionary. It's not revolutionary, and I think it's here to stay, and it'll only get better and better. I think that we're going to find out that the ultimate winner in the AI race here is the consumer. Businesses and individuals, households use AI to make their lives better, to make their businesses more productive. I don't think it's going to be an AI bubble, that AI is a bubble like what we saw in 1999, 2000.
And you've said competition is already taking air out of the AI trade. What does a controlled deflation look like compared to a real bubble popping?
I think it looks like this in the sense that when it pops, it's everybody's kind of speculating. Nobody's really thought about the downside risks. Here, you're doing a public service by discussing this issue. Is it an AI bubble? In 1999, I don't remember anybody really worrying about a bubble, worrying that there was a dot-com bubble until it burst. And then when it burst, it had a real impact on GDP, on economic activity, because a lot of capital spending related to the internet just kind of imploded. So we had a huge spending boom that just kind of all fell apart in 2000. I don't think we've got anything like that in the current situation. We may find that OpenAI is under some stress here. This is a privately held company. I don't really know anything about their finances or what they're doing, but when Google recently introduced Gemini 3 as a competitor to ChatGPT, turns out that Gemini 3 is better than ChatGPT. And Sam Altman, who runs OpenAI, issued a code red within the company, which sounds pretty existential. It's like, all hands on deck. We better work on getting ChatGPT to be a competitor of Gemini 3, if not better, or else we're not going to have the revenues and earnings down the road that we need to make all of our commitments.
And you've argued that talks around fear of an AI bubble are actually helping prevent one. Can you talk more about this and what specific signs would tell you that the cooling is actually pretty healthy?
Well, I think it's gotten to the point where the hyperscalers are spending most of their cash flow and then some. Oracle had to go into the bond market to raise billions of dollars. And what we're seeing is the bond market starting to question whether investors really should be getting into these kind of bonds. And we've seen some of the CDS insurance policies on these bonds go up rather significantly. So the market's becoming much more discriminating. It's just not buying into everything AI is a-okay.
Yardeni's view is that competition may take air out of the AI trade without bursting the bubble, but it also means big tech is spending more with far less certainty about the payoff. Bridgewater just warned the AI buildout is entering a dangerous phase as more of it leans on outside capital, not internal cash flow. UBS data showed financing deals for AI data centers jumped to $125 billion through November from roughly $15 billion a year ago. Brad Conger is the CIO at Hurdle Callahan, an outsourced investment office overseeing $25 billion. He said he's bullish on AI, but bearish on the investment boom.
I think the crux of the issue is how soon the products and services that AI is developing will actually have traction with consumers. I think that it's absolutely likely that we will all use AI in our jobs. I think it will be questionable how much of that will be needed to justify the current expenditure. So roughly, we're talking about between $2 and $5 trillion over the next 5 years. And that means that we need to justify that. We need to increase sales of final products to consumers to something like $800 billion. And there's some great use cases out there where companies have achieved $100 million in revenue on their way to $1 billion in revenue. But we're nowhere near $800 billion that's going to be needed. I think it's very likely that AI will permeate every job in the economy. We're all using it. And what we're finding, most people, is that it's impressive, but it's not a complete replacement for our day-to-day task. In other words, people have to vet it and verify and recheck. It does still hallucinate. And so I think, a real agentic AI that's trustworthy is maybe 5 to 10 years away. And that will come too late, quite frankly, for today's investment.
Even if the investment boom cools, the technology itself isn't going away. That raises a different question. What does AI actually change in the real economy? On the jobs front, the picture is mixed, but it's not all doom. Vanguard found that over the past 2 years, wages rose 3.8% in AI-exposed roles compared with 0.7% elsewhere, and hiring also grew faster, 1.7% versus 0.8%. That shows AI exposure hasn't yet translated into broad job losses. Marcus Baudet runs BIG Capital, a private equity firm and family office investing across tech and software with exposure to the AI buildout. He says AI's impact is just getting started. You've said that we're not in a full bubble yet, but you're seeing worrying signs. What's setting off alarms for you right now?
Well, I mean, I don't think that we're in a bubble. I think it's more of a matter of where people are putting their dollars. I think that there would be warning signs if, for instance, people like to try to compare it to the dot-com bubble. And from my perspective, what I saw there is you saw a lot of nascent companies without any real product, without any real market, just coming to the public market. So there were IPOs of just .com just based off the name without any real product or anything. I don't see that in AI. I think that what you're having is you did have a lot of good money chasing by, but it's mostly institutional money. It's mostly VC money. It's not the average investor that's being affected by it. Now, I think if we start to see AI companies going public at a crazy pace that have no product, have no real market, have no real traction, then I'll start to get a little concerned. But I think right now we're kind of in an area where people are just trying to figure it out. And because the money that's going after it is mostly institutional money, VC money, that's kind of designed for that risk anyway, I think that we're okay. You see that the companies that are public are really companies that I don't see going anywhere. Those are the infrastructure type companies. Those are your NVIDIAs, your core technologies that are going to be there regardless of who shakes out on top. You're still going to need the data centers. You're still going to need the chips. You're still going to need the core technology, the large language models that are being produced. But if you start seeing all these other companies start going public that are offering maybe products and things that are based off of the AI with no real customers, then I'd start to get concerned. But right now, I'm not concerned. I think it's different than what you had happen in the dot-com era.
AI companies are raising at huge multiples with thin profits. How disconnected are valuations from reality?
I think that they're very disconnected from current realities, but I don't think they're out of line with the potential that the companies are touting as, what the valuation could be, because things are going to shake out and there are going to be a few like large players in the core infrastructure of AI. And I think that those current companies that are being valued that high are those first adopters, very innovative. I don't think they're going to be displaced anytime soon. Uh, Again, if I started to see some of these newer nascent companies without any real product, without any core technology that are getting the crazy valuations, then I'd be a little bit more concerned. Most of the companies that are getting these crazy valuations actually have technology, actually are the core infrastructure, actually are doing things, and actually are driving AI or have been the drivers of AI thus far. So, and I literally think we're really at the tip of the iceberg of its how it's going to affect each and everyone's daily lives.
So a handful of AI giants now make up 40% of the S&P 500. Does that feel dangerous for the broader market?
Yeah, that I do believe feels dangerous for the broader market. I think whenever you have too much reliance on one sector of the market, kind of driving the entire market, then you're subject to any kind of peaks and valleys in that particular market instead of looking at the broader market and where things level off. From an investor standpoint, I think that it provides opportunity for those people that can identify those other markets that are being neglected, which really have, potentials to grow. And I think that from our standpoint, at least on the tech sector, it's more about looking at, what helps to drive that tech, what are the things that are behind that instead of the tech itself, because the tech is one piece of it, but the tech is just affecting other parts of daily lives.
And if this were to tip into bubble territory, what do you think would break first? VC funding, enterprise demand, chip supply, or would it be something else entirely?
If it were to burst, I think that probably the first thing to go out of those would probably be the chip demand, because people are going to try to hold on to whatever hardware or capital investments they've already made, and try not to, because those are heavily reliant on capital expenditures. So the first thing that people are going to do is pull back on capital expenditures. So you're going to see a hit to probably chip manufacturing. You're probably going to see a hit to data center development, data center acquisition, the hardware and mainframes that go with the data centers. Anything that's kind of hardware related, I think is going to get hit first, because people are going to pull back on that capital spending.
Do you think that the talent market itself is a bubble, or is it justified?
No, I agree with. I think that the talent market itself is a bubble. I mean, there are a few folks that have been at the forefront of the AI technology, and I think that that's where you're seeing, those crazy numbers. But once you start having those top end folks getting those high numbers, then it kind of trickles down to just your everyday programmer. And if that developer can say that they do AI, the value that they're adding may not be any more than any other particular developer, but that cost of hiring that developer becomes excessive.
How much of today's AI spending feels like fear of missing out versus clear strategy?
I think a good portion of it right now is fear of missing out. But again, I see that fear of missing out being, at least from an investment standpoint, I see those dollars being invested in those core companies, which again is good and bad. And I think on the VC side, they're doing some of the investment on some of the more disruptive, newer technologies. But on the spending side of it, from the, for instance, development side of it, I think that that's also a fear of missing out. People are, these organizations are going out and trying to hire these developers and spending a lot. But I think that one will settle a lot quicker. I think, probably within the next 12 to 18 months, you're going to see the market for developers start to come down quite a bit. I think that will happen quite quickly. But that one I do feel is we're definitely on a bubble for.
Oracle's recent slide shows how fragile confidence can be in the AI trade. The technology is advancing fast, but the market is now demanding proof that the spending will pay off. For Investors Business Daily, I'm Clara O'Connor.